first say that this cycle has been very different. We've had a lot of different distortions, whether it be fiscal support, whether it be supply chains, even just the general uncertainty around inflation. And if you look at the slide here in terms of where we are in the current cycle, if we think about 2023, we started with a real chance of recession in the US. Through the middle half of the year, growth started to accelerate. And this was an environment where inflation was moderating. So this was a real Goldilocks environment. Growth elevated, inflation coming down, that soft landing, or what we're calling today the productivity boom. But what we've seen recently in markets, late 23 and even today, is this real chance that central banks have to keep policy high for longer, a reflationary environment. And this is an environment where growth stays elevated, but inflation is more sticky. And in that environment, what we would say is that if the US Fed do need to keep cash rates higher, and there is a potential that we don't see the Fed cut cash rates this year, activity has to slow for central banks to be successful in taming inflation. So then there's a real risk that we do end back in recession. And we haven't yet seen any chance of, or the possibility of stagflation. So when we think about these stages of the cycle, the way in which we can think about bond market performance is through looking at a number of different scenarios. And what we're looking at here is our two flagship funds, our Schroder Fixed Income Fund and our Schroder Absolute Return Fund. And here we have modelled our current positions in those two funds and the expectation of the 1 year return across the three likely scenarios that could play out this year. And what we see in all three scenarios is the income, given the restoring of valuations, as you mentioned, puts in that buffer for any volatility we see in terms of rising rates. So in the reflationary environment, we're assuming here that rates or yields move up 50 basis points, and we see some weakening in credit spreads. In that environment, the income, a 5% yield on the fixed income fund, protects us from that capital loss when yields rise. In the productivity boom or the soft landing, again, the income on that strategy, 5% or 5% yield, puts in a decent buffer. But it's the capital we earn in a soft landing environment when yields fall about 100 basis points. Central banks do deliver insurance cuts, and it's a very good environment for credit markets. So the fixed income fund in that soft landing environment will deliver 10% returns. And lastly, in the recessionary environment, this is where we really want to be using duration within a fixed income fund to protect us for that downside against equities. And in recession, we would see cash rates potentially fall 200 to 300 basis points. Credit spreads widen, but that's an environment where we can certainly see double-digit returns being delivered from duration-based fixed income.
So when we turn to the Absolute Return Income Fund, this fund is slightly different to the fixed income fund in that it's more income-based, income-focused, and so it has more credit investment in it than it does have interest rate risk in it. So its running yield at the moment, or income at the moment, is about 5.2% annually. And so when we look at the reflation environment, when yields increase, we don't have that much exposure to interest rate risk or duration. So we only have a small capital loss of 30 basis points over the 1 year. So the return's 4.9%. In the productivity boom, oops, going the wrong way. In the productivity boom, that 5.2% income is augmented by some capital gain from rates falling, as it is in the fixed income fund, but only a smaller amount because we don't have as much interest rate risk in the portfolio. So projected a 6.9% return in that scenario. And then in the final scenario, the recession scenario, this is when credit spreads widen because corporate default risk increases, and so the credit risk that we have in the portfolio gets repriced. So there's potential capital losses in the portfolio flow through there, so we get a return of 4.5% in the portfolio for that under that scenario. But what you can see is the distinction between the two funds. The absolute return income fund has a much narrower distribution of returns, and it doesn't have that diversification benefit that the fixed income fund has in that recession scenario. So these two funds are for different types of investors. The fixed income fund's more for those investors that have heavy equities weight in their multi-asset portfolio, their portfolios, and need that diversification, where the absolute return income fund is more income focused. It's more for the sort of decumulation phase of a investor's cycle, and looking more for reliable, consistent income flowing through.